Hello and welcome back to Game of Trades, your number one channel for videos on the stock market and cryptocurrencies. The rate of inflation is coming down, it's happening, and it is bullish for the markets. We've covered that extensively over the past few months. As inflation comes down, the market tends to go up. These are just some of the episodes that I'm highlighting here where inflation coming down has been bullish for stocks time and time again throughout history. In 2022, and this time around it's unlikely to be an exception. In fact, we recently got the Producer Price Index, which is often said to be a leading indicator of CPI, of the actual inflation rate. It's coming down hard. The October reading here was a lot lower than expected, showing that inflation is really breaking down, right? In a similar fashion to other big periods where inflation had subsided. Now, of course, all of this comes after a 16% rally on the SP500, with a market that is clearly showing some signs of overextension and potentially seeing some short-term turbulence. That's absolutely within the cards. We had beautiful opportunities to buy cheap stocks back in October when most investors were betting on the end of the world. You can see here the put call premium. Investors were paying a record amount of premium. We've never seen such a distorted put call market over the last 20 years than we saw at the October bottom right here, where pretty much everybody was buying puts to hedge against more downside. But today I'm going to be showing you one chart that for me gives all the proof that this is not a bear market rally. Even though we could get some short-term turbulence and there are some signs of weakness that could potentially come in the short term, as we discussed in the last video. But in this video, we're going to be going over a chart that shows why this is probably not a bear market rally. Now, of course, that is just our opinion on the market. There are lots of different opinions out there. I like to give my opinion. I think that's what helps investors the most, because we can then show how we came up with that opinion and we can have a debate. But at least we're very clear on what we're debating about. By the way, if you are new here, don't forget to smash that subscribe button, because this is the type of video that we post multiple times a week on this channel. And also smash that like button if you enjoyed the episode. Now, without further ado, let's get right into it. Okay, so before we answer that question, before we dive into that chart, we need to provide a little bit of context. What's been driving the market lower throughout 2022? We've covered that many times on this channel. It's been all about yields. As bond yields rise, right, this is the inverse of the 10-year yield. As bond yields rise, so they fall on this chart, stocks fall, right? That's been the trend throughout 2022. So if yields begin to reverse here, that means stocks are going to reverse as well. If yields continue moving lower, so higher on this chart, well, stocks are likely to continue moving higher as valuations expand and the market prices in easier economic conditions. Now, in this piece here that we posted towards the end of October in 2022, we posted this chart here, and I found this absolutely fascinating. So I wanted to show this to you guys. This is the week-over-week change in 10-year yields in the US versus non-US but developed markets, right? So that includes Japan, Germany, UK, France, Italy, Canada, Australia, Spain, and the Netherlands. And you can see here, towards the end of October, we had this big spread that was occurring where yields in non-US developed markets were moving down, but yields in the US were not moving down nearly as much, nearly as quickly. And so we wanted to take a look at how many times over the past 20 years we've seen such a large spread. Is this something that actually happens often? Is this unusual? And if so, what does it mean? And we can scroll down just below here and you can see this actually happens pretty rarely. That reading that we got was in the bottom 2% of reading. So the largest spread we had between US and non-US bond yields. If we take a look at the 10-year yield back in late October, it was at new highs, right? It was making new highs. If we take a look at yields in the United Kingdom, for example, well, you can see they were moving down. And so that was really what the spread was showing you, that yields outside of the US were moving down, well, yields in the US were moving higher. And you can see that that's pretty rare, right? It happens, right? It happens every so often, but it's rare. And so if we look at what bond yields do following that type of reading, right? If we take all of these readings and we see what bond yields do in the 6 months after that reading, you can see yields fall, right? They fall relative to the average. and by quite a big margin. So that gives us a big bias towards falling yield when we saw that spread between US and non-US bond yields, which really gave us the confidence to say, hey, okay, bond yields, we can target 3.5% on the 10-year yield here. We can expect TLT to rise, and stocks are likely to move higher. If we look at what's happening on the UK 10-year yield today, we have the downtrend accelerating. So I really have a hard time to see that US bond yields are suddenly going to reverse back up and move towards their highs. Right? It's possible. Anything can happen in the market, especially if we get another surge in inflation. But if we don't, if we continue to see inflation move down and the economy cool down, the big bias on yields is to the downside, the big bias on stocks is to the upside. Again, that's our opinion, but if you're enjoying the presentation of this video, and if you're learning something new as we're going through these charts, don't hesitate to smash that like button. It really does help push our videos out to more people. It makes the effort and the time that we put into making these videos, it really does make it worthwhile. So that is really appreciated. Now, this is exactly the type of work that we post on gameoftrace.net that goes into our work when we put together our model portfolio. There's so much noise in the market, so much noise online, and we try and really help investors to make sense of all of it in a quantitative and unbiased way, right? As hard as that can be, the human is biased by definition, but that's one of our core missions at gameoftrace.net, is to make you cut through the complexity of the markets, bring you a simplified and educational framework to be successful in the stock market. So make sure to grab yourself a free trial and turn on those notifications to get updated on key developments. Now let me show you that chart that I find absolutely fascinating when it comes to the market. This really has a perfect track record at telling you whether you're in a bear market rally or whether you're not in a bear market rally. And I know that sounds too good to be true, and it's really quite simple, and it is the initial jobless claims. Now hear me out for just a second. Throughout this year, you've heard countless experts, countless predictions regarding the fact that we're in a recession, that unemployment is about to skyrocket higher, that earnings are going to contract, and that it's the end of the world, and you're going to see big banks go bust. And yet you look at initial jobless claims or the unemployment rate, and we're stable. We're low. We're at the same levels that we were at before COVID, right? In this entire period before COVID, where unemployment rate was low, we're at that same level. Now, I don't like to discuss what we said or what we haven't said, but because I do think there's too many channels out there that focus primarily on the track record as opposed to learning from your mistakes, moving on, and looking into the future and trying to do things better. However, this has been one of our big focus points throughout 2022, is that we weren't going to see a massive rise in the unemployment rate like we did in 2008, that it wasn't the end of the world, that we weren't going to see a contraction in SP500 earnings like Michael Burry has been so vocal about, which led to the 2000 and 2008 crashes. We haven't seen any of that. Right now, could it come? Absolutely. At one point, a recession comes. At one point, you're going to see unemployment rate rise, especially taking into account the massive monetary shock that we've had throughout 2022. But the fact of the matter is that we're not there yet. We're not seeing a steady rise in unemployment. Now, let me further my point a little bit before you guys harass me in the comments, and let's select some of the key bear market rallies throughout history that could look similar to today. Just eyeballing it, you could say this is what we want to avoid, right? We want to avoid this type of drop, and this is what a lot of people are scared about, right? You're not scared of a retest of the low. Could we see a retest of the low? It's possible, but it's not the end of the world. What you're scared of, what you're concerned as an investor, what you want to avoid at all costs is this type of drop. So we're going to select the bear market rallies that ideally you should have taken as an opportunity to get out of the market and run. So of course there's 2008, there's 2001 as well. Then if we go back a little bit further, we have the 1969 crash that I think is pretty relevant. This was a bear market rally that you should have taken as an opportunity to get out. And this one right here, around, you could argue, November of 73. So 4 bear market rallies throughout history that you really should have taken as an opportunity to get out of the market. Let me put up the initial claims here, and you're going to see in each of these examples, let me put a horizontal line here in each of these examples. You've got 2008, you've got the 2000 bear market rally, you've got the 1973 bear market rally, and the 1969 bear market rally. In each of these cases, you had unemployment rise leading to that bear market rally, without an exception, right? The unemployment market was weakening significantly heading into these moments. This is not something we've seen. We have a very strong labor market. In fact, it's only begun to cool down recently. Of course, that's our opinion. If you want to find out more about this thesis, we posted an article that really does a great job at reviewing this. And it's called A Massive Interest Rate Shock. What does it mean for earnings? We talk about this in a very quantitative framework. I think this is essential to understand what's going to happen in the market over the next 6 months. I strongly recommend you go and read that. Now, that's about all I wanted to cover in this episode. I do hope you guys enjoyed this one. If you did, don't forget to smash that like button and click on that subscribe button if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.